Welcome to Texas Capital Live. Thank you for joining us. My name is Steve Kennard. I'm the president of the AI Innovation Association. Joining me, as usual, is my friend Lee Bratcher, president of the Texas Blockchain Council. And we have JBA, entrepreneur in residence, helping us with production. Thank you, JBA. And it's going to be a really action-packed episode, a lot going on in the markets, tons of IPOs, all kinds of stuff to talk about. It's really an exciting time to be focused on the capital markets broadly. That's why we're so excited to have the TexCap conference here in Dallas on October 8th on the SMU campus. You can register at texcapcon.com, texcapcon.com. Be a part of that conference on October 8th. We can continue these discussions. We're going to have awesome presentations from the Texas Stock Exchange, the New York Stock Exchange, NASDAQ, all of whom are moving and investing here in Dallas, and top CEOs from public companies as well. That's the TexCap conference. Let's get to the docket, Lee. So much going on today. Wanted to start with something from President Trump that caught a lot of eyeballs, had people scratching their heads a little bit. I think this was yesterday he posted this. Subject to SEC approval, companies and corporations should no longer be forced to report on a quarterly basis. Quarterly reporting, exclamation point. Not sure how to read that. But rather to report on a 6-month basis. This will save money and allow managers to focus on properly running their companies. Did you ever hear the statement that, quote, China has a 50 to 100-year view on management of a company, whereas we run our companies on a quarterly basis? Not good, with 3 exclamation points. This obviously caught people pretty off guard, affects pretty much every company in America if this becomes kind of a standard. What I didn't know as I was looking into this is in Europe, a number of the exchanges have moved towards this already, not requiring quarterly reporting. Most companies just continue on. It's kind of a pretty established best practice. Most of us can probably agree it becomes a distraction to have this kind of arbitrary every quarter, you're under this microscope from analysts and whatnot. At the same time, there are large public Chinese companies that conform to the quarterly reporting. Not sure what ends up going on with this at the SEC, how quick something like this could be rolled out. But I'm generally inclined to say, let that optionality go into the market. Maybe some companies pivot to that. Maybe others stay on a quarterly cadence. Had a lot of people chatting about this yesterday, though.
Yeah, I think it's a great idea. As President Trump said, this cuts a lot of the red tape. A lot of these, there's whole legions of employees at these public companies that are working on the quarterly reporting.
Yeah.
And you could at least limit that to some extent. This is one of the top reasons that C-suite executives give when they talk about why they're not going public or that why they were happy about being taken private in some sort of transaction. So that is a great idea, in my opinion. I think the SEC should approve it immediately, and I think we'd see a lot of companies move in that direction.
It's nice, if nothing else, to see the president kind of thinking and communicating boldly around, hey, what can we do different? When we've seen a peak in the late 90s of American publicly listed companies, and then a decline from 40 to 50%, a precipitous decline over the past couple of decades, it's good to see there's this consensus forming around status quo is unacceptable, and we have to go a different path. And that takes its shape in many different ways. This is one proposal. I'm with you. Let's see if they can actually put it into action. Hopefully it doesn't get mired in kind of committees and reviews. Let people choose how they communicate with the investing public. Good move to President Trump putting that out there. And generally what I saw kind of on the timeline was positive response to it.
Yeah.
So, well done there. Let's pivot to the markets themselves. Today, we couldn't help but notice some friends of ours, formerly of Hut 8, now American Bitcoin. This is a company that's on the NASDAQ floor right now, ringing the bell. Pretty cool to see that. We've been to many conferences with Asher, the CEO there. So it's just awesome to see the growth of this company. Eric Trump, obviously involved directly with that company that's building on this story of kind of the American Bitcoin landscape, which had been Bitcoin mining focused. There's a whole potential play there around high performance computing, the AI data center play. But the name brand of the company, I think, says it all, American Bitcoin. How can you be against that?
Exactly. And you see them there on the screen. We just had them ringing the bell. I wish it was, as you said before we went live, it's got to be a physical bell.
They're
Why are
kind of
they
tapping a
pressing
screen.
button on a screen?
We need a mallet or something that you hit something.
I know.
So the opportunity there.
Opportunity for the Texas Stock Exchange, because I think they're going to have a cannon that you fire.
We are pro cannon.
We are pro cannon. Of course, there will not be a shell within the cannon. It will just be a dry powder fire.
They can figure it out. They got a big cannon at the A&M football games. We fire after every score.
After every score.
We've already got the talent.
Pretty resounding, yeah. You'll probably hear it all throughout downtown. Yeah, to American Bitcoin, congratulations to Asher, Eric Trump, and the rest of the team there at American Bitcoin. They're on NASDAQ today. This was I guess a kind of a reverse merger where they linked up with a formerly publicly traded company, Griffin Mining. Yeah, that's right.
So you had these companies that there'd been a recession somewhat within the Bitcoin mining space. You had some companies that were looking for strategic alternatives.
Yep.
That opened this up. Hut 8 was primarily at one time a Canadian focused company and has grown a lot in the U.S.
Huge presence in Texas.
Huge investment in Texas, in the U.S. broadly. And this is kind of the culmination, I think, of that evolution from more Canadian-based company to all in on America. I think it's fair to say at this point.
Yeah, they are all in, and it's exciting to see what they've got ahead of them. They've got a ton of data centers in Texas, a lot of shovels in the ground, a lot of capex, and they're gonna also work on that the HODL strategy with holding Bitcoin. They're gonna work on, I'm sure, some potential AI conversion, as most of the miners will.
Big opportunity.
Yeah, so great things ahead for American Bitcoin.
Over 2,400 Bitcoin on the balance sheet.
2,400 Bitcoin on the balance
and growing. So not a small stack.
Yep. So congratulations to Asher and the team.
Love to see it. All right. Hey, moving on and kind of the broader digital asset ecosystem. Things are hot right now all across, whether it's Bitcoin treasury, Bitcoin mining. And here we have an exchange. Gemini went public in an IPO just this week, and pretty big valuation, came in at about a $3.5 billion valuation, but raised $425 million. Not a small amount for the market to lean into this company. This company's kind of been personified by its co-founders, the Winklevoss twins of kind of Facebook fame, but this has become, kind of even a bigger success story. They were really early to the game in terms of pursuing a regulatory compliance first kind of mindset. I think this is great to see, and that they persevered.
Yeah.
Because they did go through a period of persecution. I think it's a fair word, from regulators, the lack of clarity. They were super early launching a stablecoin, which they still have, Gemini-backed stablecoin. So these guys, they've been innovators every step of the way. In the credit card game, you see the billboards everywhere for the Gemini credit card. They were really early with that kind of strategy as well. So I think we'll continue to be kind of a tone setter for the broader exchange industry. One thing really noteworthy in this, though, prior to the IPO, in a private investment, the NASDAQ exchange, where they're listed, made a $50 million investment in Gemini.
Yeah.
To my knowledge, this is the first kind of official coupling, not just that Gemini, the company, is listed on NASDAQ, but actually has them on the cap table. This comes a week after NASDAQ announced their intent to be kind of tokenization first minded. Not a lot of details on what that ultimately looks like in terms of taking the stocks listed there and tokenizing them, where, with whom, how, under what regulatory regime. Obvious at this point, Gemini is going to play a big role in that.
Yeah. And with NASDAQ making that $50 million private placement, that's nearly 20% of all the money they raised in the entire IPO.
It's not a small
amount. And I think NASDAQ has been very forward on digital assets, on the tech, on moving financial assets on chain. They have, in fact, here in a couple of weeks at TechScap and then at the North American Blockchain Summit, Kevin Kennedy, one of their executive vice presidents, is going to be speaking about those very topics. So NASDAQ is all in on moving finance on chain. Why wouldn't they be? They have everything to gain by not sort of disintermediating themselves in a sense, but keeping it all within the NASDAQ.
If nothing else,
umbrella.
It's a hedge.
Yeah, it's a hedge, if you will. So yeah, Gemini has been crushing it. Their credit card is probably, of all the digital asset exchanges, they're out in the front with their credit card offering. Coinbase has one as well. And you would think with Coinbase's distribution, they would have gotten it out there a little bit sooner, but Gemini has been hitting that hard and heavy.
They've been a trailblazer, and big focus on serving enterprise clients as well. So for the future of Bitcoin Treasury and those kind of professional services, I would figure Gemini would play a big role. That's going to be a really cool conversation at TechCap. Go to techcapcon.com. Be at the conference October 8th. We want to keep that conversation going, and there's almost daily news around this. So who knows what's going to happen between now and then. Moving along the IPO calendar, we had a long story in a company called Klarna, which became initially famous some years ago for really pioneering broader adoption of the buy now, pay later business model. The company is, I think, unique in two ways. First, it's a Swedish company that started with a Europe first focus, and we're going to hear from the CEO touching on that in a little bit here, which is rare nowadays. To have a Europe-based company kind of emerge as a tech leader in a vertical. Maybe more surprising, they were kind of on death's door. Were losing significant money, higher interest rate environment, not good for the business model, and were able to remarkably turn the company around, went through some difficult layoffs and a process around that, and have come out the other side of it as something of a leader in the new AI first, kind of AI powered fintech services. And that's really most of the focus and the messaging that's gone into this IPO. They raised about $1.37 billion. So that's a big ticket, big success. Huge payout for investors that rode with them for a long time. Sequoia and other big venture capital firms invested in this. It's a watershed moment for them, but also for this broader debate around what does buy now, pay later mean? How is the market going to receive that? What does the growth trajectory look like around that company? I'm not a user of Klarna myself, but you do see it seems like everywhere in every online store. So the growth there at least is kind of undeniable.
Yeah, and I've got some strong feelings about this, but before I share those, I'll prep JBA in a second for his thoughts on Klarna. I feel like he's got a good perspective just because I think the demographic that Klarna is going after is that 20 to 30 demographic.
Yep.
In all likelihood. So JBA, our entrepreneur in residence, falls within that category of demographic. I will say I don't think Klarna, we're not going to be inviting Klarna as a sponsor on the show. I am very much against the buy now, pay later. It feels to me like the same level as check cashing and sort of the predatory lending ecosystem.
Right.
That may not, I could be proved wrong, and I think you've got some good counterpoints to that. But my sense is the public market should reject this. Consumers should reject it. We should not be buying consumer products with credit. You don't want to be going on and buying a pair of jeans or some sort of like clothing item or some sort of expendable item on credit. It's just not a way to run an economy. And but it is indicative of where we find ourselves as a country and the concerning levels of just how comfortable we are with debt in the United States.
It's hard for me to advocate in support of financing your next pizza delivery order.
Gosh, yeah.
So you're never going to hear that from me. To play the other side a little bit, though, I think a lot of the messaging here is the evolution of the business as a tech company, as a fintech services provider, and then the comp between the traditional credit card industry, which has all kinds of predatory practices in and of itself. It also can provide a financial tool that people can use wisely. Net societal benefit there, probably negative, probably fair to say. But in any event, there has been kind of more messaging around providing credit, sometimes at more advantageous terms than your typical credit card. Okay, but I do have to share a lot of your skepticism and hesitance, frankly, to kind of champion and celebrate this at large as a society. I do want to take a minute. We have two different videos I want to share. Recent interview with the Klarna CEO, who it's hard not to like the guy and the perseverance of building a company like this, and kind of laying out a little bit of the story of how the company was grown, And I want to discuss that a little bit, and then also some interesting insight on their pivot and kind of building this brand of the AI first fintech. And what does that mean in the market right now? Obviously, it means the market likes it. The IPO was very well received. JBA, can we play that first video, please?
And
So
as we're
what we
getting that,
said instead,
here
we
it
said
is.
to all of our employees, please try this, please experiment with this, and come back and show us where you're seeing that it's creating value. We didn't say it has to be this or it has to be that. And people tried and tested and started, and it was just amazing. A lot of people started showing things, whether it was financial analytics to produce PowerPoint slides of our investor presentations, or whether it was to do, easier marketing messages, or whether it was like tons of people came with just like tons of things where they're like, look, it's worked for this and I can use it for that. And I can, save time this way. But there were also things that Klarna should not be doing in a sense. Like one great example of that was a few people came with the idea that employee engagement surveys are really boring and they don't really tell you much. Everyone goes in, is like, do you want to work at Klarna in 6 months between a scale 1 to 5? And how happy are you at work 1 to 5? And then like HR sits there and tries to interpret all these numbers and like, that's probably because, and it's not a very quality process. It doesn't really tell you much about what's going on at the office. And then we had this idea, what if AI would interview our employees?
Mhm.
What if it would interview every employee and do like a 30-minute, not to replace the human, because the human is still their manager responsible for their workday, but just to like add a better depth and understanding of what's going on. And we launched this, and it was hard to do that because you can imagine like, okay, now suddenly AI is interviewing. What if people say some sensitive stuff? It's, it's employees, it can be, things can come up, it can be all types of things. So it turned out to be a little bit more difficult than we thought, but the team was so dedicated. They launched this, and suddenly we had 5,000 or at that point of time, or 4,000 30-minute depth interviews with all our employees. And then we looked at that, and that data was just so much better than looking at those, 1 to 5, how happy are you at work?
Yeah.
And it was just clear. And the point is that team, we still actually use that product that we built internally just because it's there and it works. But that team has gone on and built other things now. Like they're not continuing that. And we're not going to sell. We're not a HR software tool company, right? But I think it's nice that we did try it and let people build what they were passionate about and believed in, because that created a lot of learnings to then start doing things that actually benefit Klarna and its customers.
Okay, so really interesting commentary there. And what really drew my attention is it's about an hour-long interview. So shout out to the Sorcery podcast. They do a good job and a little more long form, but wanted to clip that piece because when a company comes forward and says kind of we're the AI first fintech, you're thinking, okay, that must mean that they've got the best chat bot for interactions with customers, or they have the fastest and most sophisticated underwriting tool, or whatever it is. Probably the last thing I would say is, oh, that means that they built an in-house HR tool for the company. That was a really interesting revelation around the employee empowerment and kind of the culture of the company, but also the talent that they have. People that are not only thinking that, but can actually execute it and implement it. As the CEO said, often you change an HR process, particularly you insert AI, that seems fraught with people saying, I don't like it, I don't want to interact with this. To actually be able to deliver something successful for the company that, as he said, is not a revenue driver. Like they're not trying to become an HR AI company. There's already, I think, 1,000 people doing that. But really interesting perspective on allowing the company's innovative impulse to find the way that makes the biggest impact at the company. I just thought it was a cool story.
Yeah, some interesting pivots in there. JBA, we prepped you. You knew we were coming to you. What are your thoughts on this Klarna IPO?
Well, I think it's horrendous, to be quite frank. It's, you see all these, I mean, for years, people have talked about the absolute rank practices of credit card companies. And this makes that look like child's play, quite frankly. I mean, I've never used Klarna. But, the vast majority of my generation, when we've had, outrageous inflation, you have outpacing wages for 30 years now. And my understanding of the world is like, if you're not an entrepreneur and you're not in the top 5% of entrepreneurs, you're not really going to do well in life. And that's what it seems to my generation. When you have people going to concerts and they're buying their tickets with Klarna because it's like, well, you know, AI is replacing jobs now. Particularly, and another thing about this is, you know, AI is then now scanning through all of the resumes, and people are using AI to create resumes. So it's a huge cluster that is really just not going very well. And I think that Klarna is a highly predatory, you know, practice, or they're using highly predatory practices to take advantage of a moment where you know, people can't really, you know, live the life that their predecessors did. And they're using Klarna as sort of this coping mechanism to be able to do that.
Mhm.
And I mean, you know, I think that you can see average Americans are horrible with money typically, and I think it's only the debt problem that you see with millennials now, and they're when they're 30 is only going to be worse with my generation
Yeah.
with this kind of unregulated debt.
Yeah, and like we've said, you've kind of been on the front lines of this culturally, and it does feel insidious to perpetuate a mindset of I can do something now and worry about it later. It just it's hard to see how that's not culturally destructive. Will be interesting to see now that this is a public company how that might change the way they interact with the culture broadly, with the investing public, with regulators, and communicating around how this is marketed, particularly to young people. I don't have an official poll in front of me, but I would be confident in saying that the polling numbers are broadly going to reflect what we're saying here. People are somewhere between skeptical and outright outraged
Yeah.
with this kind of practice. So it's kind of a welcome to the public markets. I guess good for you that the IPO went well, but now you got to step up and engage with this issue. So hopefully we'll see more on that, and maybe more of a focus on delivering a good customer experience around fintech and broader kind of banking services in the digital age. And I do think that's already where they've been trying to go to some degree, but at the same time, it can be not that far off from a lot of like the sports gambling sites that are like, well, this is about having fun and getting together and watching a game. Really, it's not.
Yeah.
And so we have to
It's
see
about
that in the
getting
earnings.
people hooked on their product and their
What's the
app.
core thing driving the business? That's what drives you at the end of the day. So
Well, as
I
you
don't have
said-
all the answers.
As you said, they did raise 1.3 billion, oversubscribed, post IPO valuation of 15 billion.
Yeah.
I don't know where their stock's at today. I don't know, Bryce, if you can pull that up real quick, but the market responded well. Let's see. You know, I think there could be some backlash from sort of consumer protection groups, potentially even some legal, you know, challenges. I'm sure they're socking away some money for maybe some class action lawsuits or something like that. I mean,
It would seem likely. Yeah.
you could see in a similar way that the tobacco companies and cigarette companies stock up for those kinds of things.
Yep.
How a Klarna would want to prepare for that too.
So along this kind of branding, you know, comparing it to the tobacco was probably the most brutal. Along this kind of branding debate, I want to share that other video of the CEO, not really addressing directly this buy now, pay later issue, but more like how has the company approached AI? It is emerging as a leading example of how to capitalize on that value. And so wanted to get a little more of the commentary from the CEO, and let's see how we feel about that.
People are looking at you and will be looking at you as a playbook for restructuring with AI. In terms of the business units that you went after, how did you start to restructure the business?
Well, it wasn't necessarily business units as it was. So the key thing when ChatGPT came along, you know, and you know, to me, I was just reading on X and I was like, there's this new thing and you're supposed to try it. And I was like, okay, let's go and try it. And then I was just blown away. I was just like, wow, you know, this is amazing. And then I realized like, okay, Sam Altman is going to be very quickly become a very popular guy. So like, I got to get hold of him before it's too late. So I talked to Sequoia, my shareholders who were investors, of course, because they're always investors in everything. That's great. So they were obviously investors there. And I said, can you connect me to Sam? And they were sure. Sam answered. And I was just like, okay, I'm going to make up a reason to go to Silicon Valley. And I did. And at the time I got on the plane, I had a booking with Sam for 3 hours. By the time I arrived, My meeting with Sam was 30 minutes. So I could kind of see I was getting to the point where like I would not have a meeting at all.
Yeah.
So I went into this room with Sam. I was like, Sam, and I just gave him this like 30-minute speech of why Klarna was the right person to work with for adopting AI. And Sam just listened, and then like I think he was a little bit skeptical to start with, but after about 30 minutes, he was like, "Yeah, by the way, what are you doing tonight?" And I was like, "Nothing." I was like, "Do you want to come for dinner?" "Yes, yes, please." So it was really lovely. So I was at his house, so we had dinner with it, and I met his mom and stuff, and it was amazing. And then I said, "Look, we want to be your favorite guinea pig."
Mhm.
And we put up a Slack account, and we just, and what's been nice, I've been hearing from people at OpenAI. They said, "Look, you guys, we didn't think a bank in Europe would be like one of the fastest to adopt and try and test new things, but you were."
So I think there's two interesting things here. The first is at the beginning of that dialogue, it was referred to that they were going through a restructuring. So when you had this kind of AI moment a couple of years ago, the company was on the ropes and was losing money and was looking for a way to re-energize. So it was kind of right time, right place to think big about we got to do something new. So most companies didn't have that timing. The second is pretty rare to have an entity on your cap table, Sequoia, that can like pick up the phone and get Sam Altman. So not every company can replicate this kind of engagement. Nevertheless, it did strike me because, yeah, the last company you would think would have been the preferred guinea pig, as he put it, for OpenAI would be a Swedish fintech company that's losing money at that time and place, and then kind of embarked on this journey to be the leading disruptor around how they think about that. So it's a discussion I think that's going to continue to happen, is kind of this Klarna playbook that has taken them on to this successful IPO and that restructuring, and then broadly to your points, like, okay, but is that good if the tech is accelerating something that feels like it's damaging to the broader health of the consumer, long term at least? But interesting, discussion from the CEO, and I give him credit for being out in the public and doing the long form interviews. And I think that's what more and more people are going to want to see from IPO executives, is you got to go beyond kind of the 2-minute soundbite. And I will at least give him credit for that.
Yeah, and they are up another 10% post IPO.
There you go.
There you go. In a few minutes, we have John Wingate, CEO of Bank Social, joining us. Before he joins, we'll get to this Figure Markets, Figure Technologies IPO, raised $787 million, IPO price at 25, now trading above 30. Figure Markets, obviously, we know decently well.
Yep.
Kind of another one of those companies that's bridging fintech and traditional finance. What were your thoughts on that IPO?
It's fair to say this is kind of another chapter of all things crypto, fintech, AI are front and center in the market. We're going to get into this with John and Bank Social because they're very much in that space. What's interesting with Figure, I think, is this was kind of from the beginning a company that wasn't about the hype cycle in crypto and was more really focused on the niche that its co-founder Mike Cagney had coming from SoFi, which itself was a company, kind of a California Silicon Valley company that had already disrupted financial services. This company came in and said, we want to focus particularly on home equity loans and accelerating that underwriting process by using technology. And Bitcoin is a part of that. So it was less about kind of, blockchain is a part of that. It was less about sort of crypto and blockchain buzz and trying to get a token price to go up. And it was more about how do we identify the best tools to make the customer experience around unlocking the value in their home faster, better, cheaper. That's been the story of the company and getting rewarded in a big way now. So expect more energy around this kind of fintech application of that overlap of blockchain and AI. I'm glad to see it. A lot of opportunity for a company like this to continue to grow. And I would expect to see more follow-on offerings and kind of continued capital coming into the space because it's just a huge, multi-trillion-dollar type of opportunity. So won't all go to one company, but Figure's out there in the lead right now, and well-deserved and well-earned.
Yeah, and at the helm is Mike Cagney, who's got experience as the former CEO of SoFi, and is pretty out there on Twitter. He is not afraid to say what he thinks. I'm curious if they, as they become a public company, will they rein him in a little bit or allow him to continue his very active Twitter stance?
It's been very much sort of part of the new age, and we could have said the same for sure about the Winklevoss twins at
Yeah.
Gemini, who have
Yeah.
never shied away. You don't have to look hard to find their opinion about
Yeah.
things. I can respect it as opposed to the more traditional kind of corporate lawyer massaged executive. It certainly isn't without its downfalls, but more and more behind the successful IPO and growth of companies, you're finding outspoken, opinionated, but also principled executives that I don't think just shoot off from the hip, but have certain things that they think are important that maybe aren't 100% directly relevant to the company. At least with the Winklevoss twins, it's been more about just freedom and liberty in the country at large and regulatory parity and not having the disparate treatment of different industries. I'd like to think that most Americans could get behind that. Unfortunately, recently it's taken more of a partisan kind of flavor, but hopefully you have more business leaders like a Mike Cagney as well that can say, hey, you can get out and advance and advocate for certain principles and be an effective leader of a public company.
That's right. Yeah, and they're going out there with a lot of different business lines. You mentioned the real estate piece. There's also private credit, sort of securitizing credit. They applied for a federal bank charter as well.
Yeah, that's a big deal.
So stablecoins is probably on the horizon if they're applying for a federal bank charter.
They're planning to issue their own stable coin.
Yeah.
So just a lot of activity in that space. Yeah.
I do think we have John Wingate on from CEO of Bank Social. He'll be joining us in just a moment. Let's finish up our thoughts. Last thoughts on the Figure Technologies IPO.
Well, I think what we want to see here is more institutional money that validates the need and the value proposition of disruptive use of blockchain and financial services. I think it's kind of a last step in this transition from a time when if you said blockchain in the traditional banking world, you might get fired, right? That was only about a year ago.
Yeah.
I think now we're decidedly turning the page with something like this IPO into an age where it's going more towards if you don't have an opinion and a way to engage, you might get fired.
Yeah.
Like you need to think about this proactively. And I think that's part of the story that we're going to see in the credit union world from Bank Social and what they're building there. This company Figure more oriented towards the home equity kind of slice of this giant financial services pie. It feels like it makes sense and the market is validating, kind of create a niche and be a winner in that niche. Is there like a JP Morgan of the American kind of blockchain world? I don't think there is. I think there's a more decentralized, which anybody who's been in digital assets could support, a more decentralized ecosystem of innovators and service providers. And so hopefully Figure continues to be a good example of that.
Yeah, I mean, my closing thoughts on Figure are they're competing in this alternative trading system space for private securities. Ironically, they are now a publicly traded company. They specialize in private credit. They specialize in sort of the tokenization of private securities.
Yep.
The ATS space is fragmented to no degree or to endless degrees. We need to see some concentration. So my hope is that Figure Markets uses some of this capital that they are now, have on the balance sheet to acquire some of the other ATSs, do some M&A. Let's get a lot of these disparate eyeballs that are on different assets. If it's building, tokenized building, trading on securitized, and you've got some other stuff trading on T0, and it's way too disparate.
I didn't even know about T0, so you just enlightened me there.
Yeah, there's 3 or 4, probably more than that, but 3 or 4 ATSs that no one's ever heard of. I mean, maybe people have heard of securitized and perhaps T0, but there's many others, and there needs to be a consolidation.
Yeah.
Got to get those eyeballs in one place.
Yep. Well, they've got the kind of lead flag position with being a big public company now. So
Yeah.
Good to see it. Great. Well, we can move on to our next IPO if we don't have John on yet.
I think he's here. There he is. Mr.
Oh,
Wingate.
very cool. Lee,
Hey,
how's
John,
it
good
going?
to-
Oh, we got a third. Got Steve. How's it going?
Yeah, the whole band's here.
So, guys, John Wingate, CEO of Bank Social, joining us from Dallas, Texas. And we've got some exciting news to break today on the show, John. I don't know. You said that you are okay to talk about this. This is a sort of a breaking news thing. So Bank Social, traditionally working with banks and credit unions, providing a lot of the back end infrastructure and technology for them to handle digital assets. You'll have your own exchange. You're tied in with the banks, but you're now moving into the equities market, offering not only your customers, but a lot of your partners, a lot of your client customers, access to traditional stocks, traditional equities through those platforms.
Yeah, traditional stocks, traditional equities.
Tell us a little bit
ahead.
about the history of Bank Social and then dive into that announcement.
Yeah, absolutely. So we were founded back in 2022, end of 2022, beginning of 2023, kind of when I first met both of you. I think it was right around that time when I first met both of you. And, we moved into the TradFi space, wanting to help bridge that gap between what we knew was coming, digital assets, and where things were, right? And it seems like it was only yesterday, but the pace has certainly picked up here over the last few months. I think we're seeing more interest than we ever have. And then to your point, Lee, now that we've been working with all these banks and credit unions, the opportunity to get into equities, we'll talk a little bit about what that means, securities and equities and what that means and how we're differentiating ourselves in the market for these financial institutions so they can provide these new technologies. And so like tokenized securities, right? How's that going to work? And so those are the things we're working on. I can go into a little bit of that, but I'll let you maybe prompt me for it.
Well, I do want to get your thoughts too on your big competitors. Like you guys are going to be going up against Robinhood, against I think Kraken is going to be in the game pretty soon, Coinbase. So y'all are playing with giants and competing and probably focusing on part of the market where those giants are not. So you have some greenfield in front of you with regional banks, large financial institutions, but not necessarily the Bank of America's or JP Morgan's, although maybe you do have, maybe you want to break that news today too. But tell us a little bit about where your market focus is and how you feel like, you guys have the distribution to compete with, say, a Robinhood or a Coinbase as they start to offer equities.
Yeah. So, what's going on right now is that these financial institutions are losing a lot of those deposits to those platforms, right? For lack of a better term. And we see those platforms trying to become traditional banks. I think you see a lot of them opting to, file with the OCC, but what we know is that the majority of liquidity, and I was just on a chat the other day with a couple people, the majority of the liquidity in the United States, really around the world, is locked up in banks. And so these financial institutions are wanting to stem or curb the outflows to these third-party platforms. The kind of the way I talk about it, and I think what we're getting to very quickly is the days of, hey, and this is a little bit of a parallel, but the days of, hey, Zelle me, hey, Venmo me, hey, Cash App me, those are going away. And we're moving to the days of, hey, Bitcoin me, hey, Ethereum me. And that shift is really, when you think about what it does and what the open framework that it creates, no longer do you have to, Ethereum doesn't have to live within just the Venmo ecosystem. It can live anywhere, right? Bitcoin, it can live anywhere. Now, when you start to bring in these tokenized assets, when you start to bring in tokenized securities, tokenized equities, you have this whole new financial paradigm of open banking. And I think what we're going to find, and this is what we're seeing in some of the financial institutions that we're implementing our technologies into, is that we have this flux back into the financial institution, because that's where all the liquidity sits right now. That's where all the liquidity hangs out, if we want to say that. And the reason why we see the outflows to these other platforms is people looking for features, people looking for functionality that doesn't exist in these traditional application suites. And so that's what we've been able to harness, is without having a financial institution having to completely rip out or completely replace their existing infrastructure or their existing platforms, able to embed these new experiences so that they can offer these super apps, right? And so that this liquidity no longer has to make this outflow or no longer has to go somewhere else to find a new feature. We embed those features right into the financial institutions. And by providing that fully embedded platform experience where you can trade equities, you can trade securities, you can trade crypto. These are really becoming the new rails. I can see a place where in the next 5 to 10 years, and we're seeing it happen now with FHA loans. I mean, you guys heard about what happened with FHA loans a few months back, where now you can utilize those as good funds. You can utilize those in the underwriting process. We're going to start to see that with all these tokenized assets, and the ability for you to move those assets around, just like you would move Bitcoin around or just like you would move Ethereum around, is no longer a pipe dream that we're waiting on delivering. It's happening now. We're delivering it now, and the financial institutions are jumping on board like crazy. The thing that I like to equate it to is kind of the experience layer of the late 90s, early 2000s. You had this period of time where if you were able to deliver a superior experience, then that experience would draw eyes, draw people. And we kind of have been in that mode for the last 5 to 7 years, where experience won. But then we very quickly moved in the kind of mid 2000s and the late 2000s to a price-based economy, where price discovery started to happen, and where experience was something that everybody could build, right? Anybody could build an app, anybody could build a website, anybody could build that experience, that Expedia experience or that Priceline experience. And then what started winning was price. And when you look at how the financial layering happens, certainly you have the idea that banks could go away and that just money will live on its own outside of banking infrastructure or banking ecosystems. But the reality along that same path is that there's a lot of liquidity stuck in these financial institutions. And so the majority of liquidity, I was just talking with Caitlin Long last week about how there's quadrillions of dollars that are moved we talk about the amount of money moved in stablecoins. Every day there's quadrillions of dollars moved, or every month or every year. I can't remember what it is, but it's a tremendous amount of money that's sitting in these financial institutions. And all these other platforms, when you look at Robinhood, when you look at Venmo, when you look at Acorns and Cash App and all these things, they're literally layers on top of banks. So the cost of capital, when you look at the acquisition cost, the cost of capital, but everything you're layering on top of the base layer, which is the bank, it really starts to reshift the focus of, if now financial institutions can level the playing field by delivering that experience to the members, and money becomes interoperable, where you can move money from bank A to bank B, or your Bitcoin from location A to location B without needing an intermediary or without needing an experience that's a walled garden, you fundamentally shift the way finance works and the way value transfers in the world. And I think it's exciting that America is taking, and Texas really with TexCap and with everything you guys are doing, is taking a leading role in that future of how economies will work. And we're excited to be riding right along those rails with you guys.
So, John, I think you articulated really well the economic incentive for banks and credit unions to embrace this technology, from the simple perspective of watching their deposits leave for institutions that were providing services that consumers want. So that's really powerful and good to see you're bridging that gap and helping those services come up to speed. The other side, though, I think you've been at for years, is the regulatory and compliance piece that I think also slowed down adoption, and we're seeing kind of a debottlenecking from that confusion and all the lack of clarity. Can you just comment a little and give us, I feel like you were on the front lines of the struggle with us as well for years of, can you do this or can't you, or are you going to get a Wells notice or not? And jumping through these hoops. And now we're finally transitioning to that point where there's a more solid, these are the boxes we're going to check, that's been done, and we're taking off together. Give me your perspective on that.
Yeah. So we were quite fortunate in the early days. We we partnered with credit unions and the NCUA very early on, and I was also fortunate enough to be able to help craft some of the guidance that came out of the NCUA back in 2022.
And
And
sorry to
we
interrupt,
specifically,
John, but the
no,
NCUA
go
is
ahead.
the primary federal regulator for credit unions. Yeah.
That's right. So the NCUA is the National Credit Union Administration. It's the equivalent of the FDIC and the OCC, but for credit unions. They work very closely together. A lot of the same rules and same laws. But the NCUA was actually the first regulator in the United States that passed positive guidance, positive regulatory guidance to go out. And I'm proud to say that, I worked with that to modify that guidance to not be blockchain specific, but to be DLT in nature, and to use that verbiage throughout the document so that we could be more broad in the applications. And so we were fortunate enough to be in a space that was actually not doing the Mother May I version where you had to go and get explicit approval. And so we did see a faster adoption. But you're absolutely right, Steve. When it came to kind of everything else surrounding the idea of blockchain to be used for identity, that's some of the early use cases we saw. People thought that it could be used for decentralized identity. Of course, money movement is now a big thing. But it really, to your point, Steve, until we started seeing in late 24, the ideas that were coming out of the early McHenry Waters bill that turned into Stable and Genius, and then some of the other stuff that started to come out from the SEC around just how big was it when they said memes? A meme is not a security, right? And they started talking about not your keys, not your crypto, and if you were holding the keys, and even some of the early Ripple decisions. So as we started seeing this, certainly, but we felt and we knew that the laws that applied to existing, certainly we thought there would be some new carve outs and there would need to be some new definitions, and things like the stable bill, I think, are very well placed. We didn't see that this was a whole cloth new regulatory shift that needed to happen. I think the shift that needed to happen was saying the things that they've been saying, which are, hey, look, these things behave very much like existing securities. Here are a few carve outs. And I think most of that just went to solidify what we've been thinking, and then for the financial institutions to be able to step in and not have that concern with, oh man, are we going to get skewered here, or get sent to Wells notice, whatever that is, whatever could have come from that.
I have a quick question for you, John. What about offering equities? Did you guys have to get additional licenses there, like broker dealer, or utilizing licenses with your partners, like the banks obviously have that OCC charter?
So we ended up going robo advisor. So we have a robo advisor through the SEC, and that is really cool because we kind of mashed up, with tokenized securities, here now. They're no longer a pipe dream, right? They're here now. Layering in AI, which is now taken a major leap, right, and creating this whole new robo wealth advisement infrastructure. That's really something that we're providing to the financial institutions as well, because the ability for somebody to self-direct or go into this robo wealth creation advisor, and with the opening up of financial rails and the opening up of access to these tools to anybody, you really start to create an environment, reduction of middlemen, reduction of costs. I mean, there's so many things that we could talk about that level the playing field for your everyday user of a banking app. And so by combining all that, by white labeling it, by putting that, all those regulatory layers that need to exist to, make the bank feel comfortable and protect the end user as well. We've got a really special stack of technology and licensing, and then go to market that allows us to bring essentially a super app right into a financial institution and give them access, and their customers, their business members, access to all these tools that otherwise they were having to, the app cornucopia. How many of you have pages of apps? Right. I know I do. But this open banking environment is going to really allow us to reduce the amount of apps we need because of the interoperability of money that's coming. And so I think that what you will see is your wallet will, our solution is self-custody. So like one of the things we're pioneering is going to be the ability to take your stocks without selling them. And you can do this with ACATs right now, like an ACAT transfer from, Fidelity to a Schwab or whatever, but it takes, 12 hours, whatever. But now you'll be able to do that with tokenization. You'll be able to do that instantly, right? Or even importing your wallet. And so we focus on segregated accounts, self-custody accounts. We kind of really believe in the, owning your own crypto, owning your own assets, being able to self-direct, and the financial institutions do as well. So, and we try to keep them out of the business of becoming custodians. I think a lot of, to your point, Steve, that you were making earlier, what we're going to see is we're going to kind of see a bifurcation that's going to happen right now. We're already seeing it, where you see people coming to market that are just trying to make hay while the getting's good. But they're not really looking at regulatory compliance. And because most of these, the smaller, medium regional banks don't have the in-house expertise, we're seeing a couple different things happen. But I think that by focusing on, remaining regulatory compliant, putting the right tools in the customer's hands, we're going to see a big move, a shift away from walled garden finance to open economic trading of value.
One more regulatory question for you, John. Did you guys have to do anything with related to transfer agents? Do y'all use a transfer agent? Will you use a transfer agent when the equity starts to trade on your clients? Y'all are providing the back end technology, obviously, but how does that look?
Yeah, so there's the security space is kind of well established. So you have your broker dealer, right? And they're separate from the transfer agent. And then you have an RIA like us that can sit on top of a broker dealer and a transfer agent. And so absolutely, there are still transfer agents in place, still have the broker dealers in place. But what we're really talking about is the ability for the transfer agent's really there for when the stock is bought and sold or moved, and who holds what. And then if it's true, the broker dealer is really just there to facilitate the trade. They can charge a fee. But when you're a user and you're just taking your money, you're not selling it, you're not moving it from Fidelity to here. But now with tokenization, I'm really just taking my self-custody wallet and moving it to the next institution or the next institution or the next institution. There really isn't a need for a transfer agent in that scenario. And so you're fundamentally shifting. If I don't sell my assets, which most of the time when people are moving, that's why ACAT was invented, is because people didn't want to sell, right? And that's why our solution in the market for Bitcoin and for XRP and for Ethereum is really taking off, because ours is the only platform too that doesn't require you to sell your crypto to get it back into your bank account, to put it right there next to you, right? Because of the interoperability, because it's connected on chain, because you can send and receive. We don't require you to sell your assets like all these other, or most of these other platforms did. So yeah, absolutely, Lee. There's still, and we've talked with the SEC about this. We've talked with a lot of different people about this. We don't think broker dealers anytime soon, at least, are going to go away. We don't think transfer agents are going to go away, but we do think there will be a fundamental shift in the way assets move, the way assets are recorded. And you're already seeing that. There are some transfer agents. We had one in here, I think, a week and a half ago or so, right? And they're focused on utilizing DLT to maintain record of with smart contracts and with very sophisticated things, but they're doing it in an all new way. But the underlying fundamental thing that they do, which is record who owns what, is still completely in play. It's just the mechanism by which money becomes interoperable, or value or securities equities becomes interoperable.
Well, John, I can certainly echo your support, and I think it's important what you're doing around empowering people to actually own their own assets instead of getting trapped in yet another kind of layer of custodial, cost structure that they don't opt into. You want a custodian, you can opt into that, but you should have the choice to actually own your assets. That's what Bitcoin and the broader digital asset ecosystem is all about. So thank you for, adhering to those principles and exciting stuff you're working on. Certainly look forward to having you on again to get an update. It's like every week you launch a new thing. So it's great to see.
Thanks, guys. Thanks so much.
Okay.
Have a great day. You guys do a fantastic job. We love you guys.
Thanks, John. Cheers.
Thanks, John.
Thanks, guys. Bye.
Yeah, go check out Bank Social. Really cool what they're doing. Really cool to see after years. Sometimes it seems like these things are like overnight success, or it's all a new product. To some degree, it is. But as John said, it was 3 or 4
Worked out
years
for a
ago.
while, yeah.
Yeah, we were first talking about this concept and the long road of that regulatory struggle. But it's paying off to have a partner like that for institutional financial players to be able to get into the space. So
That's right.
great to hear from it.
Well, we should transition to our next IPO, Angel Studios.
Yeah, so this is an interesting kind of different flavor, right? We've talked a lot about tech and about blockchain, and that's in the headlines. This one I think snuck under a little bit. So Angel Studios for years now has kind of been part of the alternative media landscape, most well known for Sound of Freedom, their kind of hit movie, and the Chosen series that they produced. This wasn't on my radar in terms of plans to go public. I'm a little surprised. Want to highlight a few things about it. So this was a SPAC kind of listing, so not really a traditional IPO. So they've merged into Southport Acquisition Corporation, which was an entity created purpose-built for this kind of thing on the New York Stock Exchange. But most interestingly, from the beginning, they've had a different approach to capital raising. It's always been this kind of crowdfunding phenomenon and empowering people to not only provide the funding for movies, but through that to vote for what gets made. So this is how they kind of first created these viral moments of what kind of show would you like, kind of vote with your dollar sort of concept. But in this case now, they actually had it's called a Regulation A plus crowdfunding campaign, different kind of subchapter within the SEC fundraising guidelines.
So accredited and non-accredited could participate.
Exactly. That's the important piece here. Non-accredited. This is for small kind of crowdfunding investments where they hit the maximum, which is $55 million, which is pretty remarkable.
Yeah.
From tens of thousands of
individual
investors.
Yeah.
So did that prior to going out with this SPAC deal. And I think it just kind of shows this next chapter of this different emerging media landscape of how brands interact with the public at large. They also raised up a $100 million credit facility with Trinity Capital to provide additional liquidity. It's safe to say you can expect some big kind of blockbuster type movies in the near future from Angel Studios. But more than that, I think it would have been really hard to even imagine this a couple of years ago when it was so marginal. They were kind of scraping at the edges of the broader media landscape. You really didn't have distribution. It was so dominated by a couple of players. And they kind of said, you know what, we don't need Netflix. I think they do have stuff on Netflix now. But they said, you know what, we don't need that. We'll go straight to the consumer. That's the story of media at large right now.
Yeah.
You know what, we don't need the old ways. We'll go straight to the consumer. And if we deliver the content that they want to see, that wins at the end of the day. And they've won here with the stock. No huge run up, but it's been a little volatile like most of these SPAC IPOs are, and now kind of leveling out. And we'll see. I think the market's probably waiting for the next announcement around like what's the next movie gonna be?
Right.
What's the next kind of piece of content that drives this thing forward.
Yeah, $1.6 billion valuation is, I'm sure, nothing that they expected 5 years ago.
Unthinkable.
Yeah. Especially when before The Chosen was a hit series, and millions of people across the world have watched that. But yeah, I'm excited to see what they come out with. Just a little personal rant. Hollywood is struggling to put out quality movies, so I'm excited to see.
At least they won't make another Avengers.
Oh my goodness, yes.
Which is just unwatchable garbage as far as I'm concerned.
The 90s were like the golden age. 90s and early 2000s were the golden age of movies. Like really sweeping epics like Gladiator and other just excellent. Last of the Mohicans, Daniel Day-Lewis. Just you don't see that anymore. They're too expensive to make.
The other week, my wife took the kids for a trip, so I was here alone. I'm like, maybe I'll go see a movie, and I just looked into it and said, how much does this cost for what?
Nothing.
It didn't make any sense. So I think I was living in that mindset of years gone by. So I'm not going to hold my breath for Hollywood to get their act together. I am rooting on Angel Studios. Won't be in the S&P 500 anytime soon.
Nope.
But I'm not going to bet against them, because just this milestone is something to be really proud of.
Yep. And so moving on, we've got the IPO pipeline. What we expect to see in the coming weeks. Steve, you flagged several of these for us, StubHub being one of them.
So I think it's tomorrow, StubHub's going to come to market. And this is really different in the sense that this is a pretty mature company.
Yeah.
In a mature niche in the industry. There's only a few players that are kind of these ticket reselling marketplaces, and was a relatively low growth. I think last year they had 3% revenue growth. So some growth, but it's not this sort of high flying AI powered buzzword IPO or whatever you want to call.
The only way these companies are making money is they create little mini monopolies for themselves.
Well, this is the play. That's right. You said it well. There's been M&A over the years, so they've swallowed up most competitors, consolidated into this. You're getting to a point, you want to go to a concert or a football game. It's kind of StubHub.
Ticketmaster or StubHub.
Yeah, and so they're raising $850 here. That's their target, which is a big chunk of change. It's a thermometer, I think, for
live events.
It feels like now the IPO window is wide open. I mean, we've had a couple of like banner IPOs and they've rallied afterwards. Most have been the kind of tech, AI, blockchain focused. This is a first big one that kind of doesn't have that story. It's more just we're a company that's developed a dominant position in our niche. We're throwing off cash flow and we should be rewarded for that. And we'll see how the market reacts to it. So that's going to be something to keep an eye on. And again, is not a huge valuation that they're looking for at 9.3 billion in terms of what you see with these giant kind of tech company type targets, but it is a significant capital raise. So you're going to have a lot of institutional players participate probably to get to that number. So something to keep an eye on this week.
Yeah, what else do we have in the pipeline?
Also in the pipeline is Fermi America. This is a very interesting company, big Texas exposure, co-founded by former governor and department and energy secretary Rick Perry, and was announced kind of some time ago and has now come out with an intention to move forward with an IPO on the New York Stock Exchange, but also indicating potentially on the London Stock Exchange as well, which I thought was interesting. This is kind of a holding company that's developing a very significant project in the Texas Panhandle outside of Amarillo. One interesting piece of that is that it's a collaboration with the Texas Tech University system, which is pretty dominant in the West Texas area. There's some eye-watering numbers here. The outlook is to build an 11 gigawatt data center. Sometimes it feels like we pick a number and then you just got to go higher. So whoever's next, you got to announce 12 gigawatts or you're just not going to get a headline. But 11
and to
gigawatts.
Put that in the context for the audience, 11 gigawatts is more power than a lot of U.S. states consume.
Right. I mean, it's a truly hard to imagine in a single campus, single project.
The largest to date is like one that's currently operating 1 gigawatt. So this is like 10x.
Yeah. So I think Elon's big campus outside of Memphis is kind of approaching that 1 gigawatt, which seemed like an insurmountable, incredible thing when he did it less than a year ago. So now we're talking about 10x that. I think this is also interesting though, in that it is kind of from the outset an energy oriented company. You're going to monetize that energy with a data center strategy, but first and foremost, it's a land and power play. We talked about this last week with Iron around their focus on the real scarcity is land and power, and the hardware and monetizing through data centers will come after that. So this is over 5,200 acre site outside of Amarillo. And you have a confluence there of it's super windy. There's all these wind farms everywhere there. You have significant proximate natural gas production, and maybe most interestingly and potentially powerful small modular nuclear reactors. As Energy Secretary, Rick Perry was a huge champion for that. So he's no newcomer to the idea that nuclear is kind of the way forward. But with the new push at the federal level in the current Trump administration to accelerate nuclear build out, this company's really looking to capitalize on that. Seems like few would be better placed than Rick Perry to kind of lead a charge around that. I can't think of a more logical place than out in West Texas, where we know the power is abundant and cheap already. And then down the line, you can build into these nuclear sites to get to that 11 gigawatt kind of target.
Yeah, and they could be right on that fiber backbone that runs from Dallas up through Lubbock to Denver.
Good point.
So
There is
probably what they're targeting, for low latency. 11 gigawatts is going to be a problem because for a lot of reasons. One is because there's just not enough transformers and equipment to substation equipment to build a facility that could consume that much electricity.
Yeah.
You can get enough NVIDIA GPUs there. You can get enough of the hardware, but you can't get the electrical infrastructure and the transmission infrastructure built in any sort of reasonable time frame.
Yeah.
So my bet would be we are well past 2030 before 11 gigawatts is realized.
It's exceedingly difficult, with the supply chain.
And they
issues.
probably are well aware of that. I doubt that they would say they could get 11 gigawatts built before 2030. There's just no way.
It's a bold outlook, and it'll be interesting in the case of Fermi America, but also some of these other headline-grabbing infrastructure investments. Do they start to go further up the value chain to invest in that supply chain, particularly around building out substations and the transformers necessary?
Well, Giga Energy, one of the companies here that they were working on data center equipment and went to build transformers because they couldn't find any.
Right.
Now they're building a transformer factory in Texas.
And then they figured out, what? The actual thing is the transformer.
There's a lot more money in building transformers
right.
than there is building data center infrastructure.
Yeah.
And because they were building sort of the last mile piece, so, the PDU power distribution units and the infrastructure, like the physical infrastructure in which the machine would sit.
Yeah.
And they still build that, of course, but Giga Energy's out there now building transformers.
We need it.
And there's no shortage of demand. They're closing huge contracts.
They may have a customer here at 11 gigawatts. You'd be working for the rest of your life. So
Yep. We should make that introduction. If we do, Giga will be a sponsor of the show.
So we'll have to do that. So keep an eye out for that. No date for this Fermi America kind of outlook, but it figures to be a headline grabbing thing, big capital raise, a lot of different investment banks involved in this. And I think it's a good story for Texas, and this is what the country needs. Like, we have to accelerate this nuclear infrastructure build out. We talked last week about that as well. So with these kinds of companies making these kinds of investments in Texas, we've gone through a couple of years here where one of the most contentious and kind of politically fraught subjects was the electrical grid. This was in the aftermath of the winter storm that we had here, 4 years ago now, where there was a major power outage. There were deaths associated with that. It was really a real tragedy. And just a deeply troubling time for most Texans that this could happen here. We're the energy capital of the world. How is this possible? So I think our government has been trying to answer that question for a number of years. In this last session, you were really involved in a piece of that discussion and a kind of watershed piece of legislation, Senate Bill 6, that seeks to put us on a path towards answering how are we going to build out all of this infrastructure and service the needs of industry, but more importantly, as Texans that live here, the needs of all of us as people. So wanted to get your perspective on this, as it's very timely with all of the stuff that we're talking about here. What was that like? Can you give us an overview of SB 6 and just shed some light on the process?
Yeah, let's start with setting the stage with the problem. There is a lot of energy generation in Texas, but we sometimes, on very small percentages of any annual time frame, have trouble getting that generation, that energy to the end consumer. That's a transmission challenge, right? Transmission is very expensive, and because we have so much wind and solar that has very intermittent performance, it's really difficult to build transmission, to those locations, because you don't know, well, is this wind facility going to be performing, when the wind's blowing, they need 100 megawatts worth of transmission. When it's not, they need zero. And the transmission is physical infrastructure, so you can't just, move it on a moment's notice when the wind stops blowing. So you're having to build out a lot of transmission infrastructure. It's very expensive, and it's not being utilized to its full capacity because wind and solar is intermittent. Now, that's not saying wind and solar are bad sources of energy. They're excellent, and about a third of the Texas power consumption is powered by renewables.
Right.
And that's a growing number. So we're up to, at some points we're at 40, 50%, depending on how sunny and windy the day is. So with that as the context and the backdrop, we have Senate Bill 6. Senate Bill 6, there is just an unprecedented amount of demand. The energy grid in Texas was used to growing about 1 to 2% a year. 2% would have been a good year. Now we've been growing at leaps and bounds, 6, 7, 8% a year, which is just unheard of. And they've been struggling to keep up with the infrastructure build out that's required for that. So a lot of this growth is large data centers. It's AI, it's cloud, it's Bitcoin mining, it's traditional, it's all of the above. And there is a queue to build infrastructure in Texas that is the same size as the current consumption of the entire state. So we're about an 85 gigawatt peak load state of the amount. That's 85,000 megawatts, just multiply by 1,000 to get the megawatt number. And there's an interconnection queue of a similar size. Now, a lot of that infrastructure is not coming. People are bidding on multiples, saying, hey, we're going to build a 100 megawatt site to a data center, but we apply in 5 different places. And those 5, that looks like 500 megawatts is coming, but really we only have the capital to build 100 megawatts. So with that backdrop, the Texas legislature said we had to do something to clear out the queue. So they did put a few provisions in there that made sure that you can't just apply 5 different times without telling ERCOT that this is a duplicate application. ERCOT needs to know that, hey, there's not actually going to be 5 different sites built. You have to demonstrate positive control of the site. You can't just say, hey, I'm going to lease the land and hope that the ground lease comes through. That doesn't work. You have to demonstrate positive control. So a lot of well-needed reforms in the ERCOT queue that will shrink the size of the queue and give ERCOT a more accurate projection of the infrastructure that's going to be required moving forward. The other thing that was very uncontroversial. The thing that's somewhat controversial in the bill was they said that all data centers over 75 megawatts have to be willing to curtail and have ERCOT install a remote disconnect. So ERCOT can open the breaker and remotely disconnect your data center in the event of an emergency. That is fine for a Bitcoin miner and to some extent other types of compute, but not for cloud infrastructure, for certain types of AI compute. That's very problematic as well.
And this is kind of the way that a representative can look their constituent in the face and say, we want this investment in Texas.
Exactly. We want the economic growth, but we will not let them be on.
That's it.
And you get a blackout in your neighborhood.
If the lights go out at the local school and the data center's still humming, that's a political problem.
That's a bad look.
Yeah.
So in that scenario, if the lights do go out at the school, either the data center will be off because it's been curtailed, but more likely it was just a tree fell on a local power line. It's a localized problem, not a system-wide problem, right? I think people need to understand that. So that is, again, a little bit controversial because these data centers are investing billions of dollars in creating a ton of economic growth. Very large taxpayers, far larger than
in rural areas,
average.
Very significant.
Exactly. In some rural areas, some counties, the largest employer and the largest taxpayer. One data center can be the largest taxpayer and the largest employer. So there's a little bit of tug and pull here. And I think helpful, needed, a bit, perhaps a little bit too far in certain circumstances, but that's how policy works. It's tug of war, and hopefully we land somewhere in the middle.
And it moves a little bit to the implementation phase now with the Public Utility Commission to tease out a few of the details. It'd be interesting to see as you get all these huge announcements that we're talking about here. If you start to have a shift, now that we have more mechanisms from a regulatory perspective that require certain costs and posting of capital and ability. If you start to shift more towards what do you actually have approved in the queue to be energized in terms of your data center versus like these big public companies that right now are just going around and saying, well, $200 billion, just, make an announcement sort of thing. And so we're going to have to start to transition a little more to what's real. How do we do that? Even to your point, even if you intend to build that out, can you get the transformers? So hopefully SB6 can be a tool in moving us forward in a way where we don't have a fallout with the public at large, that this isn't in our collective interests.
Yeah, that can't happen. So it is a tool, and let's see how it's implemented. I think it's all in the implementation that the Public Utility Commission has in front of them right now.
Interestingly about SB6 was generally a bipartisan initiative. It was controversial in its ways, as you said, but not so much along like heated partisan lines. So we're going down that implementation path as this is a first step in kind of the Texas way, maybe, of approaching and dealing with the economic activity around electricity at large. But a lot of this stems from the data center build out that's going on. So I want to highlight that because I'm going to talk a little bit now about another state that is often our rival in many ways, and that's California. And similarly there, California's had a bill, SB 53, that hasn't been a big partisan issue. It has now passed both the House and the Senate and is heading to Governor Newsom's desk. And this bill is focused on the AI safety issue. So a little bit of background about this. In the last legislative cycle, you had, I think it was SB 1047 was kind of the first big iteration of this AI safety issue in California. And it was flying under the radar. And then all of a sudden there was a big kind of uprising around it, most notably around its intention to assign liability to model developers for all downstream applications of that model. And that was pretty much universally opposed by, I think, anyone in private industry, certainly. I think you get a few academics to agree with anything. But almost no one says that, when you have a product like ChatGPT being used by tens of millions of people, that you should be held liable for every action that somebody uses that to do. I've often characterized this to people. It's like if you sell shovels and someone takes a shovel and beats someone to death, you don't go and sue the shovel manufacturer. That's a little bit nonsensical. Gavin Newsom ended up vetoing that bill. So pretty rare that it makes it all the way through, actually to his desk a first time around. Industry kind of rose up. He vetoes the bill and then convenes a panel to talk about this. Now, the two main co-hosts of the kind of committee that was assessing this were professors from Stanford and UC Berkeley. So a little disappointing to me that there wasn't really as much of an engagement with the industry. I think the reason is that most of the industry says we don't need this. The state of California creating this whole regulatory regime to insert itself into private industry. Notably as well, at the federal level, when we had kind of the one big beautiful bill, there was a whole discussion there around AI and a heated debate on both sides of the aisle around a moratorium on state level regulation. And a lot of people pointed to the dangers of California implementing an overly onerous regime, which would hinder an industry that is serving the country at large, not just California. Mm-hmm. Ultimately, that failed. So the bill that passed did not include a moratorium on state level regulation. And so you've seen them now pick this back up in the form of SB 53. Now, it has removed that liability for all downstream actions. Even these academics and people that had been advancing that, I think broadly recognized that's not a workable framework for something like this. This is, to me, still concerning in that it inserts a state into a private industry that affects the other 49 states. So I think there's an interstate commerce issue here that they are overstepping their bounds. If this were to pass, I think it goes straight into the courts. the way this is currently contemplated, and to some degree, the arguments from the side that are supporting this bill are saying it will only apply to companies with $500 million or more of revenue. So that's basically just the big frontier model developers. However, let's not be so naive. That's how it starts. And then it becomes a way to impart undue influence on a broader industry around what constitutes safe or not safe. At the end of the day, my opinion is you're an adult living your life in a free world. Some things you just have to learn how to deal with. The government can't be there to determine what is and isn't safe in every application. I'm disappointed this bill doesn't really deal directly with protections for children. I do think the state has a role there. When you have a tool that's being rolled out broadly in the retail world, we have a collective interest as society to have protections in place in children. You've seen a lot of discussion around that in Texas. So this sits on the governor's desk. SB 53. To my knowledge, he hasn't made any statement about it. I think he's got until early October to go one way or the other.
Do you think that some of these large companies, OpenAI in particular and others, would relocate outside of California were this to take place? Obviously, it would affect all of their customers in California, so they would still have to grapple with it, but maybe just as a statement of protest.
It's a good question. So far, Anthropic has supported this bill. Now, Anthropic from the beginning has been what I would characterize as sort of a doomerism-centered agenda that they've advanced, that the government needs to save us and have a framework for AI safety. So it doesn't surprise me that much that Anthropic would come out publicly and support it. I'm not saying they don't have a good product. I've used it myself, but they have always been more out front with this sort of inviting in the government to insert itself in AI development. Most other companies have been silent. Last time around, there was basically a revolt in Silicon Valley saying, this is crazy. So the craziest piece, that liability for all downstream actions, has been removed. I think what you have here is kind of a Trojan horse type of bill that once this is unleashed, the government never becomes less intrusive. This is the first step, and then you're going to start layering on other things, and you create bureaucrats and committees that start interpreting, well, this bill said that you have to come up with a program to keep your AI safe. I think it means this, 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 and this. Would a company move for that? I think you're going to see pressure around that. Hard to see OpenAI moving just because they're so entrenched in the San Francisco culture. But for instance, Meta has moved a lot of employees to Austin and grown a lot there, and has said, we need more diversification across the country and ideological differences, since they've had a history of issues with the ideological bias of their platform. So I don't think we can write it off. And this is the sort of bill that it will impact the potential presidential ambitions of Gavin Newsom as well. So it is far from a local California issue.
Yeah.
It's a national issue.
Yeah. Interesting to see. Well, we'll see in the coming days whether he vetoes this or lets it ride.
We don't have long. All right. Hey, moving on. We had some big news in the stablecoin world. Tether has always kind of been the market leader globally in US-backed stablecoins. They've gone through a long past of some struggles, frankly, with compliance issues, transparency issues. I've generally regarded that as a company growing at an incredible pace all across the world and just struggling to get their arms around it. I've never seen proof of bad actors or, deliberate malfeasance on the part of Tether, but they've been in the headlines for that.
They have it, but we did not see whether or not, they were, holding treasuries to back all of their liabilities. They were holding other assets. They were holding cash and cash equivalents. We never really knew to what extent those, there was probably a few years in there. The 2021 year comes, 22 in particular, where those margins might have gotten a little bit tight.
Yeah.
But I think there's no doubt now, with them pursuing a Big Four audit, there's no doubt with the increase in value in some of their other investments that they have more than enough assets, cash and cash equivalents, treasuries, et cetera, to back their liabilities and outstanding stablecoins in Tether USDT that's outstanding. And they're the most profitable company in the world on a per capita basis. 60 something employees and 12 billion in net profit.
It really is great. It's just a cash machine. So the big announcement this week, they're launching a new Tether USAT that's a US domiciled, US compliant, US focused Tether. And to head up that initiative, they have Bo Hines, who was the former, I'm not sure what his title was, but the kind of
executive director of crypto
focused White House staffer.
Yeah.
I think that almost all in the industry would agree he served with tremendous distinction there and was part of bringing a lot of the regulatory framework that's going to allow for this innovation to flourish more in the US. So it was a big announcement when he left the White House. You knew it wasn't going to be for something small.
Yeah.
This is a huge deal. And I thought we would share a little video here because it's, well, first of all, it's showing, I think, the advancement in AI videos, because I thought it was pretty sharp, this little commercial. We wanted to share this here and kind of how that brand is being put out into the public. Let's show the video, JBA.
Money today moves like it's stuck in the last century.
Your money will arrive to Mexico City in a week.
A week? Because the transfer team is still on a yoga retreat.
Do you want some lemonade?
Hey kids, give me a cup.
$100 bill. Looks good, but useless for a $1 lemonade. But with USAT, money finally works like the internet. Faster to get paid, easy to split. Backed one-to-one with liquid and stable reserves. No middlemen, just instant money. USAT, dollars that move as fast as you do.
I didn't realize that was a AI generated ad.
Well, I'll have to look at it closer. I think it is, but the video editing there is getting more advanced each passing day. I thought it was interesting. You got the red, white, and blue, and this kind of star logo.
Looks
and
like Captain America.
It's got a Captain America vibe, and I think that's probably exactly what they were going for.
Yeah.
Is Tether's
Bo
kind of
Hines is kind of like Captain America.
He's got that ethos, he's got that vibe. They found the right guy to helm this thing. So they're going to headquarter this in Charlotte, which I think is Bo Hines' hometown. They have Anchorage Digital Bank, which was the first federally chartered digital bank. They've been around in the space for a long time. They are going to be issuing this new stable coin. And then you've got Cantor Fitzgerald which has had a long relationship with Tether as an entity. They'll kind of be heading up the management of the reserves themselves, which figures to be a lot of U.S. government bonds.
Yeah.
And so this is a collection of top tier entities with a big track record. Not totally clear yet. Is there like a USAT app that's standalone for the American consumer?
What's the distribution?
What's the distribution?
They could
Who are the
buy
key
distribution, I think, because they could be capitalized, by Tether, the mothership, and buy distribution through whatever channels they want. Create partnerships. I mean, I think it's a very legitimate competitor to USDC, to Circle's USDC in the United States.
Extremely legitimate. Expect to see a lot of those commercials. And I think there's a natural first entry point in the different communities that are sending money back to their home countries, which is where stablecoins have flourished.
Yeah.
Are in areas.
And Tether has flourished.
And Tether has always been the global leader for that kind of remittance market where dollar demand is very high in economies that suffer from high inflation or currencies that, we can't even pronounce. You have that diaspora here in the US that is a natural user to kind of onboard this. But then you take the next step that they have that brand recognition to become like the settlement mechanism of choice.
Mm-hmm.
I think across the economy, nobody has the track record, depth, and experience that Tether has had around the world. For the US consumer, it feels new.
Yeah.
But for the larger global economy, this is a behemoth. And
they move more money than Visa.
And they've shown they can do it,
Yeah.
Consistently. I'm super bullish on the concept. We'll be keeping my eye out. I want to play with it myself. I'm certainly going to be a user of this just as an interested person in the industry. But what I'm confident in is they're not going to come small on this.
No.
We don't quite know what Bo Hines is cooking with the rest of the Tether team, but it'll be something big. Expect Super Bowl ads, expect giant endorsements with key businesses to to roll this out, but it's going to go 0 to 100 miles an hour real fast.
And I think what we really need to watch out for, I think if I were them, I would be focusing on the U.S. Trade relationship, the companies that are major importers and exporters. USAT could be the settlement layer of choice.
Yeah, it really could.
Because that's really where they've dominated is B2B payments globally outside of the U.S. That's USDT has dominated that. They've dominated also kind of the stablecoin market for consumers as well. But the volume and the size of the transactions are not as significant.
You could see them going down the street here as the headquarters of Kimberly-Clark, and they're selling paper products all around the world.
Yep.
And there's got to just be enormous efficiencies there. And what this could do also for the dollar's status, which has been rocky this past year, dollar performance largely in the markets.
Yeah, 10-year and 30-year has not been great.
This to me looks like an antidote, not just Tether, but they're the biggest player.
Yeah.
And so to really take this to the next level, this is an entity that that can take things to places that, again, we keep saying it on the show, were unthinkable just 1 or 2 years ago. And now
the growth rate is 72% annualized growth rate of stablecoin market cap. And so right now we're over 200 billion. Secretary Treasury Besant is estimating 3 trillion by the end of the decade.
So it's like the holding, it's more than most European countries on a standalone basis, which is absolutely remarkable. And Tether also pioneered kind of a model of taking some of their reserves and making strategic investments. I think their Rumble investment has been a huge winner for them. So they've announced, Tether integration into Rumble for creators. So we'll have to start streaming on Rumble. But it's a model that you can expect 100%. You're going to see them investing in like strong American brands. I don't know which ones those are, but brands that everyone identifies with is like, this is an American company.
Yeah.
You're going to see Tether bringing capital to the table. I think it's a great thing.
I think regional banks would be a perfect partner. Regional banks have a lot of political prowess in their local, at the state level in their, dominant areas.
Yeah.
Tether Bank of America would be a good brand too. Just Bank of America.
It's in Charlotte.
It's in Charlotte. That's a good potential partnership too.
They actually have enough money to buy it probably. So.
Yeah.
That's what's crazy.
Partially, I don't know if Bank of America is ready for that yet.
Yeah.
Because they have their own designs for stable coins. They want to be a competitor.
That's the boom we're seeing right now is kind of everyone wants to have a stable coin that's attractive.
Yeah.
But you have the network effect.
Yeah.
And Tether and USDC are like really
nobody.
entrenched.
Yeah. I don't see, and that's why it's a perfect partner for a regional bank because regional banks aren't going to launch their own stable coins. Most won't, anyways.
I think you have a good theory there.
They've got consortiums. They build teamwork. They build partnerships, and then they can compete with, JPM coin.
Yeah, JPM coin. Well, Bo Hines, we're rooting for you. We'll be keeping an eye out for what's next at Tether. Let's go to Kalshi. We want to check a few of the kind of prediction market odds. We're finally here this week around the Fed's decision on interest rates. It's been a little bit of speculation in the market that maybe a 50 basis point cut could be in the making. And I was looking at this with JBA earlier, and I think it has stayed at 90-something%, 25 basis point.
Really? Okay.
And
Where are we
single
today?
digit, more
single
than
digit,
25 basis
more than okay. So the announcement's tomorrow.
It is. I was surprised. I would have thought maybe there would be some movement on the 50 basis point kind of thing with kind of the continued consternation around jobs and all of that.
Yeah. What are we thinking, JBA? Are we at 10% for a 50 basis point cut, or are we still below 10%?
We are. When I looked earlier, it was the not 25. So, hold on just a second, wait for this to load.
Here we go. We got it pulled up now.
Yeah. So, this is specifically looking at
Number of rate cuts in
number of rate cuts in
2025. Yeah.
I thought this is an interesting addition to this conversation. So
what do we have here at the top? We've got 35% chance on
2 cuts.
exactly 2 cuts, and then 50% chance for
3 cuts. Yeah.
yeah. So we're transitioning towards, I think what we're seeing the market reflect here is high confidence that you have a 25 basis point cut this week, but where more we're expecting maybe 2 cuts before year end, you're trending towards 3, so successive cuts in successive
So
months.
75 basis points in total, essentially,
75
is
in
where the
total.
money's at.
Yeah.
And that's more the shift. So it's been less that we're going to accelerate things with the 50 basis point cut, more towards more cuts than were being discussed before. Just a month ago, the Fed was super dovish, you know, is in question whether they were even going to cut this time. So there's been a move there.
Yeah.
In general sentiment.
And are we between 5 and 5.25 right now? Is that where we're cutting from?
I think it's 4 and 4.25, I think.
Okay.
Yeah. And so it's an ongoing debate around the Fed's role in the economy at large when you have that dual mandate. The jobs reports have not been good, but the stock market's at all-time highs.
Right.
So there's a disconnect where there is no clear way here. So no matter what they do, you're going to be maligned by some constituency within that. So
What else we got in Kalshi, JBA?
I saw a funny post from Kalshi saying NVIDIA is worth more than Canada. I don't know if people were betting. I don't know if there was a prediction market around at what point does NVIDIA cross over for Canada. I don't know if it says more about the success of NVIDIA or the lack thereof in the Canadian economy.
Well, you know, Texas is slightly bigger from a GDP perspective than Canada.
That's right.
So NVIDIA is coming for Texas next.
We won't let it happen.
We won't let it happen. We're the 8th largest economy in the world. I think Canada's the 9th or the 10th. Yeah, and you were right, by the way. We're cutting from 4. So right now the range is 4.25 to 4.5.
Yeah. Okay.
So by the end of the year, the majority, the odds are we're going to be under 4 clearly, probably in that 3.5 to 3.75 range.
And the big debate will be when they cut, does it actually move the treasury rate and these other benchmarks that actually translate?
I don't know if it does.
And that's the thing, is the markets have kind of become disjointed from the Fed sort of just ordering what the outcome is going to be, and we've seen that phenomenon emerge here. So tomorrow's a big day.
Who's buying 10-year U.S. Treasuries right now? Stablecoins are buying, well, short term. They're buying 90-day. But
I suspect there is a very real, potential outcome here where you have a cut and there's little to no improvement in the actual borrowing rate for companies.
US, yeah.
And it that becomes kind of the big headline. And then your question is the big question: how do the rates go down? More people want to own bonds. Who wants to own more bonds, government bonds, right now when we're 35 trillion in debt? The only growing buyer that we've seen are the big stablecoin issuers like Tether. So what a remarkable place to be in.
Well, and if we get to that point where they're cutting and the 10-year and the 30-year aren't responding and the borrowing cost of the United States, remains higher, there's really 2 options. You stop cutting.
Yeah.
Or you start printing.
Yep. That's the speculation. So gold and Bitcoin looking pretty good right now.
Yeah.
Well, we'll continue to monitor the Kalshi markets, which have really emerged. I think in this cycle of discussion around the Fed, we've seen a more and more kind of mainstreaming of the prediction markets in this. Seen it, I think, happen in politics this last election. I think it's now having its economic moment where a default kind of thing to consult. The first thing you say is not what is the consensus of some suit somewhere say that is going to happen. The first thing that kind of collectively market watchers are consulting are the prediction markets that companies like Kalshi are putting out there. So
and you've
just
got
really
live data. It's so responsive. I mean, JBA, pull back up you just had up the will TikTok be acquired in 2025? And just even within the last, I don't know, couple hours, it's spiked. any idea? I mean, this has probably happened since we've been on the show. Why are we spiking? Why is TikTok? Obviously, I think it's the ban.
I saw
Potentially US ban.
speculation, so maybe the speculation has converted.
So some
to,
American
a TikTok
social
deal.
media company's going to acquire TikTok because of the CFIUS government, U.S. government concerns with Chinese ownership for TikTok.
It is amazing to see that spike and that response to that.
I mean, the number's too small for us, JBA. What's the percentage chance that TikTok gets acquired this year?
58.
58%. So better than not.
So there you
Yeah.
go.
That in the next 3 or 4 months, TikTok gets acquired.
You know, it's kind of wild to me that, you know, somebody who's traded crypto for a number of years, you know, growing up kind of in that prime time zone, seeing the 2017 and all the other bull runs, it's like, you know, now we not only do you have, you know, your emotions heightened with, you know, I'm seeing my money go up and down at like rapid speed, half a second, but now it's like arbitrary sort of like abstract ideas are now being betted on in real time. It's just I don't know. It's a wild thing to see. And you're right. I mean, it's like another thing I'm interested in is Kalshi or Polymarket ever going to get into polling? And if that's the case, like I'm curious, is that going to get rid of polling companies as we understand them?
Yeah.
I think, okay, here's a prediction. Polling with no monetary incentives, pretty garbage.
Yeah.
I think Kalshi or Polymarket could get into polling with micropayments.
Yeah.
And say, hey, answer this poll, we'll give you 25 cents of USDC. And it's a quick 1-question poll.
This
right?
is a really interesting thread to pull on. Most people don't appreciate the sheer amount of money spent, or I might characterize it as wasted,
on phone-based bank.
This political polling that most of the time is to prop up one agenda against another. People aren't actually searching for the real truth.
No. 'Cause you can bias the polls based on how many landlines you call versus how many cell phones you call, and any number of other demographic factors.
Yeah.
But if you
Great use case.
if you create a big sample size and you kind of balance those kind of variables and you provide a small micropayment incentive, which was not possible before in the world of credit cards, but
Yeah.
in this world that we are in now, it is possible. That could be a really powerful tool.
No, yeah, it'd be wild to see. I think every polling company, I don't think they're going to transition. They're dinosaurs and they're not really going to adapt. But it'd be interesting to see if they did put that in, and sort of like the issues they deal with. But
You'd have
I
to
think,
elect
highly-
them to
I think
outsource
that's a business line for Kalshi.
Yeah.
To take clients that want to get polling information from their accurate user base.
absolutely.
You could see that just be hyper adopted because the murky world of the old polling is so abused.
And it's so expensive.
Yeah.
Absolutely.
Here's the quote from President Trump. We have a deal on TikTok. I've reached a deal with China. I'm going to speak to President Xi on Friday to confirm everything up. This is according to the Schwab Network. And according to reports, Oracle will be a key component of that deal. That's actually a nice
Segue.
transition.
Yeah.
Because as if Oracle wasn't making enough news with this, we've been talking about the big headline numbers on CapEx in the AI world. So Oracle had this big announcement that's left me, frankly, a little bit confused. So you've got $300 billion deal with OpenAI. I've heard this referred to, and I don't have the quote from where, but I saw it somewhere, it's stuck in my head, as the AI house of cards. You got this company buying from this company, buying from the other company. Like NVIDIA stock goes up, Oracle stock goes up, OpenAI is in the private markets. Who's really paying who here? But you've got a $300 billion commitment, 5 years starting 2027 to deploy this. A lot of this is related to the Project Stargate here in Texas and Abilene. So this was announced before. Remarkably, upon this announcement, you had an over 40% jump in Oracle stock. You had
40%.
and this is an already very significantly large company. Larry Ellison, for some moments, surpassed Elon Musk as the wealthiest
I
person
saw that. Well,
on
this
Earth.
person in the world.
So just an enormous move on, something that hasn't fully come to fruition from a revenue perspective. OpenAI loses money today.
Yeah, a lot.
So the question remains, who's raising the $300 billion? At what cost of capital? Who's getting diluted where to deploy that? I haven't seen it.
I think the amount of PE money and VC money, initially VC, but now private equity money in OpenAI is infinite.
Yeah.
And then that's just going into NVIDIA and the hyperscalers even in some cases, some of our members like CoreWeave and Core Scientific.
Yep.
And those are all publicly traded companies.
The other
So I
side
think
of
the
this,
dilution is for the private equity companies.
yeah. Well, and your point is a good one. The other side of this is it kind of creates this like race to make a bigger announcement. It doesn't seem like there was a lot of market pressure to firm up the financing around this. So everyone else is kind of rushing then to get a bigger deal and a bigger announcement. As we've talked about, like, how do you deploy this? Your point's valid. There's kind of infinite private equity. We're going to test that. How infinite is that infinite?
Yeah.
Because we may find out at some point you need a return on capital that can't just be sort of stock market speculation based. Look, I'm rooting for it as an American. I want investment in our tech infrastructure. This one, I'm scratching my head a little bit in terms of valuation. And what I'd like to bring in for our kind of discussion is, so Perplexity, I got to give them a shout out in terms of their Perplexity AI product. About a month ago, I think, the CEO of Perplexity kind of mused out loud, like, people pay so much for Bloomberg Finance terminals. They're like 20 something grand a year for the subscription. He said, we should disrupt that. And then they launched this Perplexity Finance product that they have continued to improve. We can show it here on the screen, kind of the landing page there. I'm just impressed with how much they've improved it. Now, about 2 weeks ago, they launched AI powered stock analysis. And I thought it would be cool, starting with Oracle, to look at a few of these reports because it really gives an interesting kind of flavor of analysis. It also, we talked about robo-advisors with John earlier. It sheds light on this new world of AI powered analysis and just how kind of detailed and in-depth that can get. They're really cool reports. And, it's $20 a month for a premium subscription to Perplexity. So I'm not saying it does everything that Bloomberg does. They wouldn't claim that either. But they're
it's not far off.
The advances are really remarkable. So I just wanted to read a little bit from the Oracle report because I think it's really interesting. First, right at the top, you get this AI disclaimer. This report has been created using generative artificial intelligence. Basically, you can't trust anything in there. But I spent some time kind of chewing on this. Very interesting. Just came out the other day. The recommendation is a strong sell with a conviction level that is high, according to Perplexity. So bullish on Oracle with a 12-month price target at just under $162 a share. And we're up over, 200 right now. So a significant pullback from current levels. And I wanted to read a little bit from their core investment thesis because I think it touches on like what we're talking about here. It says Oracle presents a compelling paradox for investors: exceptional operational performance and transformational AI and cloud momentum, coupled with extreme valuation overextension that creates substantial downside risk. While the company's Q1 26 results showcased unprecedented demand, with remaining performance obligations surging to $455 billion, the current stock price reflects excessive optimism that cannot be justified by fundamental analysis across multiple valuation methodologies. They go on to kind of give more assessment around establishing a peer group, which is really hard to do because the other big competitors, AWS, GCP within Google, and Azure within Microsoft, are not pivoting in the way that Oracle is kind of becoming a default pure play AI cloud, enterprise grade specialized company. That's kind of the transformation that they're going through. So hard to establish a peer group, but just making that argument around these remaining performance obligations, as they call these IOUs, is maybe how I would characterize it, for these big announcements. Just really interesting analysis and a bearish outlook on Oracle from the Perplexity AI report.
And they had a target of 160.
They had a target of just under $162 a share. So
wow, that's crazy. I mean,
big pullback.
That's a big pullback.
Like very bearish.
Yeah.
So another way of saying it would basically be this recent huge bump is gonna deflate. That was sort of a euphoric reaction to the headline announcement around this $300 billion deal with OpenAI, which doesn't even start that kind of deployment or execution on that doesn't start till 2027 anyway. So you're way out there before you've even got the first milestone of actual execution around this. So valuing that in the present day, is what they've characterized as substantial downside risk with extreme valuation overextension.
Extreme valuation overextension. I mean, they are taking all the emotion out of this and just putting it out there for everybody to see.
Yeah, and it's a neat report. It's it's 56 pages long, and it gives different kind of cash flow assessments and discounted analysis around that. So really interesting. Now, on the flip side of that, thought it might be fun to do a couple of these reports, talk about a couple different companies. We've referred numerous times here to power is kind of the most important piece of the value chain. People can't get the land and power. We're seeing things de-bottlenecked at the hardware level. Few companies have been better positioned on that front than Vistra. So Vistra is a Texas-based company, operates all across the country.
Headquarters here in DFW.
Right here in DFW, has already seen a big run from the 60s not long ago in terms of share price up to over $200.
Wow.
So
in the last year, I think, right?
Big run around this kind of AI narrative. And frankly deserved, because there are very few entities out there that have more real experience and assets available around deploying power than Vistra. And Perplexity here does have a recommendation for a strong buy at a high conviction level with a $232 12-month price target. So not a huge step up from where we are, but they lay out the thesis behind this. And if you continue to get these kind of multi-gigawatt type announcements from people, at some point, there's got to be an entity with real experience delivering that involved in some of these mega projects. You could see a Vistra. So there's kind of an unknown unknowns bull case out there that goes beyond this, but just on the cash flows, they're at a strong buy for Vistra.
And very counterintuitive from the last decade of Mag 7 splashy technology stocks. This is an old company that builds power infrastructure, mostly natural gas generation, but they have a fleet of any number of energy generation assets.
That's right.
And kind of a sleeping giant that has been awoken and, had a 3x in their stock price in the last 12 months.
I like the juxtaposition of a negative outlook from Perplexity on Oracle, which is like Wall Street darling right now.
Yeah.
High flyer. And then you've got the quote unquote boring utility. Maybe they used to pay you a little dividend and it just kind of all of a sudden not so boring, and a much more bullish outlook.
Because who can build natural gas power plants in the United States? Probably like 4 companies
that have a real track record.
Yeah.
Instead of just making announcements. That's where they differentiate themselves. The report says the investment narrative centers on 3 transformative forces converging simultaneously. Explosive AI-driven electricity demand growth, up 165% by 2030, according to Goldman Sachs projections. Sector-wide consolidation, creating oligopoly-like pricing power. And federal policy tailwinds, providing over $500 million in annual nuclear tax credits through 2032. Under CEO James Burke's leadership, Vistra has delivered exceptional operational execution with 114% revenue growth, transforming from recurring losses to $2.8 billion in net income while maintaining best-in-class governance standards. And so not only do you have the wind in your sails from the AI going on, but they have the actual asset base to deploy nuclear and do that in a real way, and then a management team with an execution track record. So unique company, Texas company. I like the report. I'm going to agree with Perplexity on this one, bullish on Vistra. Next up, you probably heard of this one, Apple. So in the headlines this week with the new iPhone out, they have a sell recommendation on Apple with a high conviction level. It's been down a little bit off of this iPhone announcement, not a huge movement. So stocks in the 230s, they have a price target just under $200. So not a huge pullback in terms of the price target, but I think they articulate here the issues around Apple. It says Apple represents a compelling long-term franchise trading at an unsustainable valuation premium that fails to reflect mounting execution risks and competitive pressures. While the company maintains exceptional ecosystem advantages with over 90% customer loyalty and generates 108 billion in free cash flow from a 391 billion revenue base, the current share price embeds unrealistic expectations for AI monetization and China market recovery that are unlikely to materialize within our forecast horizon. I think the characterization here from Perplexity is spot on. As an Apple user, I've been befuddled to outright shocked at just the lack of AI execution. And what I see here is a company that feels like it's starting to accept they're good at making phones and they're going to focus on making phones. And that's got a long-term cash flow attached to it. But do you get to enjoy the exciting AI multiples? You don't, unless you're going to execute in that space. Apple Intelligence, I mean, I turned it off on my phone. It was just annoying.
Yeah, it's not good.
It's really outrageous when you've got so many resources available to ship a product like that. You would be better off, I think, just publicly saying, look, other companies are doing the $300 billion deals. We're going to just focus on having the best phone.
Can I throw a little something in
Go
here
on
as
in.
well? I'll say that, I don't know if you noticed that Zuckerberg is now working with, or with Meta is now working with Luxor Exotica, right when they created the Meta glasses.
Yeah.
And from my understanding, he's planning on having Meta own I think I'm correct on this, have partial ownership of Luxor Exotica. I think he sees the future, which is we're not going to have this thing in our hands anymore. We're going to be wearing glasses, and
Yep.
the UI is going to go away. We're not going to have user interfaces as we understand them because AI completely changes that.
Yep.
And so I'm interested to see nobody knows who's going to come up on top of that, and because everybody made fun of Zuckerberg when he transitioned Facebook into Meta. I think it was just before its time.
Yeah.
It wasn't ready yet, but he saw the future, and that is here. And I'm curious if Apple's going to be able to win.
It was like a joke at first, but nobody's laughing now with the I haven't tried the glasses, but I would be interested just from what I've seen of how much better they've gotten and just the broader kind of virtual reality play here. To also give a little bit of a bull case for Apple, because I don't want to just hate on them, big American company. They have gotten really good through the iPhone at condensing an incredible amount of computational power into smaller and smaller.
They're very good at hardware.
Kind of form factors.
Very good at user design and interface.
So top in the market at that. This new iPhone has an improved kind of cooling technology with the vapor chamber in there that dissipates heat better so that it doesn't overheat, so that it allows it to perform at that higher level. So they're deploying that into the market. So it looks like they can retain kind of a bit of a cutting edge position as these LLMs are getting more and more compressed. And there's a near-term future I could see where you could have more on-device. You can run models on device today. It just feels like with a step up in computational power and increased efficiency of the models, you're going to reach a point soon where you can run more of it on the phone, and it dissipates kind of the need to have this Apple Intelligence product that makes the phone compelling. It comes back to who has the best phone that's the most dependable, doesn't overheat, has the best efficiency and all of that. That's an area where Apple does shine, is having that high quality kind of premium brand positioning. So I have to lean towards aligning with what Perplexity is basically laying out. Hey, these guys are getting away with valuations that have no basis in their execution around AI, which has been atrocious. I'm not defending the Apple execution around AI, but they do still have this premium franchise position. They do have a VR arm as well. So they've got that going in terms of the potential shift from the form factor to something that's more of a wearable. So I'm not writing Apple off today. Probably a little high with where it's trading right now.
Okay, I've got a little bit of bearish and a little bullish, but bearish first. China is not going to, iPhone sales are not going to recover in China because China wants a state-owned champion to dominate the smartphone
Yep.
market in their country. So I just don't see Apple sales rebounding enough in China to make up for their projections, or what they kind of their rosy projections on sales in East Asia.
Yep.
And agree with you on the Apple Intelligence. What could be a bullish case, and what I don't know, and would be curious on y'all's thoughts on this, is they're not a good AI company because they don't have a lot of data. It's not like Tesla where they're pulling in all this, XAI, because they've got Twitter data, they've got the video data from Tesla.
Yep.
Google obviously has got a ton of data.
Huge data funnel coming in.
Huge data funnel.
YouTube, yeah.
But Apple has a lot of data, but are they allowed to use a lot of their data is sort of privacy for good reason.
Yeah.
User data.
Well, and they've always positioned themselves in the markets, whether you think it's real or not, as a privacy
centric.
Yeah.
And I'm glad they do, and that's a little bit to their disadvantage right now.
It is. It feels like at a point they got to come out and say, look, we're a hardware company.
Yeah. Yeah, and just continue to buy your phones from us. They're going to be more expensive, but that's okay. We'll
It's
still
a premium
do it because
product.
it's the premium.
And here's I think the thing you really transition to is, if you look at the price of the Meta glasses, it's not extraordinarily expensive compared to what you think it is.
Right.
Obviously, we're not to the point where the UI of the future that's in this, in a lens in front of your eye, we're not quite there yet. But my question is going to be, okay, if their whole business model has been selling something for $1,500, $1,700, and quite frankly, it's just a leasing program. Hardly anybody ever actually owns the phone. It's just kind of a forever payment.
I am rare in that regard, but most people.
and so my question is, like, if your only improvement really is the camera a little bit, well, I mean, once all of your applications can move to an AI assistant that speaks in your ears through the Meta glasses, and you have everything you need talking to somebody, you don't have to interact with this anymore. What's their business model?
Yeah.
And I mean, that's not going to be next month or next year, but I think it's going to get here a lot faster than people are ready for.
I tend to agree with you in the long term, but I think the moat that Apple has around kind of the App Store and the app ecosystem is going to be pretty insurmountable in the next couple of years.
Yeah, they do have the App Store as well that we didn't really touch on as a revenue cash cow.
Yeah. They've taken a few hits on that in the courts recently.
They're getting it from all angles.
Yeah.
I mean, the golden child of Apple is teetering, it's safe to say. And Tim Cook's going to be under more and more pressure to kind of land this plane and come up with a strategic plan that makes sense, because what the market's agreeing on, I think most people are agreeing on, is Apple Intelligence ain't it.
That's not it.
That's not working. I want to end with one last company, because this was the most kind of under the radar company you don't think of probably really at all anymore. And that's Lululemon, which is a Canadian company and was like the hot thing, however many years ago, for mostly like yoga clothing. Then they expand, they become kind of a broad athletic wear company. They've just gotten absolutely hammered. If we put up the stock, you can see this thing dropping off here, mostly from a lot of the tariff related pressures.
Bryce, can you go to the 6 month?
Yeah. And so it's just been kind of down here. And they've been, in the estimation of Perplexity, and I think there's a compelling argument here, they have a high conviction level for a buy on the stock. So
just because it's been hammered so much recently.
It's been hammered so much. You're trading down below 170. They have a 12-month price target almost up to $300. So like 70% upside. And the theory around this is that there is an underlying cash flowing business that is now trading at, they point out Nike is trading at about a 20x enterprise value to sales multiple. Now, Nike's the number one brand in the world. You'd expect some premium there, but Lululemon's all the way down to a 10x. So you basically are getting a double, the multiple on a Nike. And there's an argument around, does that make sense? Who has more opportunity to grow, like the giant incumbent or a Lululemon that has shifted in reaction to this market to focus a lot more on China and to sell there? And I was having an interesting conversation with my wife about this, where we kind of realized, as an American, you're thinking Lululemon's kind of like, that's last year. There's so many other brands now. They're under huge competition pressure here. But that isn't the growth story. It's taking that kind of brand that still has some cachet, if you will, to these Asian markets, and there's potentially a lot of upside there. The report says the investment thesis centers on Lululemon's enduring competitive advantages, premium brand positioning with demonstrated pricing power, which is true. They don't cut their prices. They've always been relatively expensive. Industry-leading margins and returns on invested capital of 66%, and significant runway for international growth, where the company currently derives only 28% of its revenue versus a target of 50%. So they've basically come out and said, we understand the market thinks the tariffs are going to crush us. We're going to pivot. We're going to grow. And there hasn't been an acceptance yet in the market of that reality that they're going to execute on that.
But I'll agree, and for two reasons. One, because the consumer base in South Asia and East Asia is 3x, 4x the North American consumer base from a sheer volume perspective. And this is not like an iPhone that costs $1,200. The second reason is this: in the same way, the Chinese government does not care if they have a state-owned champion in apparel manufacturing.
Very good point.
They don't give a rip.
Yeah.
And so there's not going to.
They make it all already. They're just putting a Lululemon brand on.
They're not going to put their finger on the scale on that. They're why would they? And lastly, the American export that continues to dominate is culture.
Yeah.
And Lululemon has been a big part of female culture, I guess, in the United States for the last 5-10 years or so.
Strong brand.
And they've got a strong brand, and we're exporting culture. There are people in India and China. All it takes is for some Indian actress or Chinese actress to start posting on, oh gosh, what's the Chinese equivalent of
WeChat?
WeChat, yeah, all these different apps, and
it takes off.
They could sell double, triple what they sell in the U.S. in China.
Well, I make the point that over the past 15 years, a lot of people in my generation who got rich off of drop shipping, you notice that, starting an apparel brand is not difficult anymore. You can get a really good supplier and design what you want on a supplier in China in a consumer type of way. Like it's like, you're the user on a platform looking for a manufacturer. It's not really an institutional thing anymore. And so, it's kind of like, all these places overseas are kind of like a couple of years behind the culture here. So you can make a lot of money there, but now anybody can start an apparel brand and make really good stuff.
Yep. So we spent the whole day pretty much talking about AI, energy, data centers, everything going on there. But the contrarian investment opportunity emerged where you least suspected it.
Apparel.
Which was yoga pants for
Is that a value investing? Is that a win for value investing?
It's an interesting report because a lot of it is cash flow based. It's just like, get down to the numbers. Credit to Perplexity AI for really interesting product and putting some interesting analysis out there. Made me think more. I'll think differently next time I see a Lululemon store. But enjoyed that. We'll have to get more of these reports on future shows. They're rolling a bunch more of it out. So good work, Perplexity, on the product. Look, this has been a great 2 hours on Texas Capital Live. And again, we're just excited to continue this discussion at the TexCap conference. Go register at texcapcon.com. And thanks again for joining us.
See y'all next week.